Hi, I'm Matt Gilligan from Gilligan Row, and I'm here to talk to you about a basic tax structure for a salaried property investor. Now, I'll just point out that this is for a New Zealand property investor buying investment properties in New Zealand that are residential in nature. And what I'd sort of start by saying is make sure when you're setting up a tax structure that you not only think about what you want from an accounting perspective and a tax perspective, but also what your lawyer wants. And by that I mean think about asset protection, estate planning, and your relationship property issues, as well as the tax outcome you're trying to achieve. That's what a good structure will think about. Not only what you want from a tax perspective, but also what you want from a legal perspective. So in this regard, it's ideal if you can get your lawyer and accountant talking to each other and get them to come together and make sure that it's working for both sides of the fence. We call that an asset plan as opposed to a tax plan. You're getting the legal side and the tax side dovetailing together. So this is more of an asset plan for a New Zealand property investor buying residential property. So let's have a look at what I would say is a poor structure first. I think sometimes we need to look at the negatives before the positives. And what I would call a wrong tax structure would be where sometimes your lawyer or your accountant elects to put everything into a trust. Here the rental portfolio has gone into a trust. And what's wrong with that is if you're negative for tax, your tax losses tend to get locked up in the trust. You can't get tax refunds because losses will be retained in a trust, they can't be passed through. And it's also important, I think, that when you're thinking about this point, don't put negatively geared assets into trusts. Don't just plan for today's interest rate environment, plan for the future interest rate environment, because interest rates will go up over time. So point number one, don't put your negatively geared property investments into a trust. An alternative option is you and your spouse owning the portfolio directly in your own name. And again, I think this is a no-no because over time your circumstances might change. Maybe one spouse stops earning, maybe you have children, or maybe one of you retires or just simply stops working for some reason. And if you have the assets held jointly in your names, you have a deemed partnership for tax purposes, and you have to split the profits and losses from passive investment, being rental investment, 50-50 in this circumstance. I have seen some accountants using disproportionate splits, and the IRD's view of that is that it's tax avoidance if you own the asset jointly in this fashion to not share losses and profits from passive investments 50-50. So don't put assets straight into your name, or you have to split the losses or profits 50-50, which could be contrary to what you're trying to achieve from a tax perspective. Another real disadvantage of owning the asset directly in your name like this is as you pay the debt off on the portfolio, you can't then pull the money out of the houses that you've been paying down on the mortgages and recycle that money off your mortgage on your family home or your loan on your family home. Remember, the loan on your family home is not tax deductible, whereas the debt on your investment portfolio is tax deductible. So it's best practice from a tax perspective to pay the debt down on your family property and leave the debt over your investment properties. If you've got a partnership, it's very difficult to achieve that because you've sunk the money into a jointly held asset, and when you refinance the money, taking it back out of the partnership, the intention of borrowing is to pay down the loan on your family home, which is not tax deductible from a tax perspective. That does not meet the criteria under the deductibility rules for interest to get a tax deduction in that circumstance. However, if this was a company, it would meet the criteria, you would get a deduction. So that's a real advantage of a look-through company or a company structure over a general partnership. And it's probably one of the primary reasons why you should try and avoid partnerships. So, okay, we've talked about what's not an ideal structure from a tax perspective, from basic investment property structures in New Zealand. Now let's look at a good basic structure for an investor. Now I'll just comment and say this structure is for salaried property investors in New Zealand, so New Zealand tax residents. There are better structures for self-employed people, is the point. So I'm talking to salaried people with this structure. We've got other structures for self-employed people. The structure is current as at January 2014, and tax laws do change over time, so you need to check with us to make sure that the New Zealand tax laws haven't changed since I shot this video. And check that this being a generic discussion, check that this structure is appropriate for your circumstances. And it's so key when you're setting up your structures to take advice off a professional, because sometimes it's the little twist or the way you structure the shareholding or the way you structure your finance that gives you the tax advantage or gives you the asset protection. So you really should take professional advice when you're doing this. And also be aware that if you move assets, there are tax consequences. So if, for example, you decided a look-through company was good for you, and I'm going to discuss what a look-through company is in a moment, and that was appropriate for your family, and you decided to move assets into the look-through company, remember when you move assets, there are tax consequences. Depreciation recovered, for example, on your existing rental investments. You won't be able to avoid that with a related party sale to the look-through company. So I would recommend taking advice before you act on anything that you hear in this video. So let's start with what is a look-through company? Well, a look-through company is a separate legal entity. It's a company. It's set up and incorporated just like any other company is for business. Because it's a residential portfolio we're discussing, there won't be a GST registration, so it's not registered for GST. And quite simply, the company ticks a box with IRD, and the shareholders and directors fill in a form to elect to become this thing known as a look-through company. And the consequences of that are the losses and the profits become transparent for tax purposes, meaning that the IRD disregard the company and they treat the entity as a disregarded entity, and instead tax the profits and losses as if the rental portfolio held by the company are held directly by the shareholders in the proportions by which the shareholders hold the shares in the company. So in other words, it's as, from IRD's perspective, it's as if the company doesn't exist, and if the shareholder owns 100% of the company, then the shareholder is deemed to own directly, for tax purposes, 100% of the rental portfolio. So that's good because your profits, your capital gains on your properties, your surpluses from an income tax perspective, and your losses flow through the company to the shareholders as if the company doesn't exist. And that's what you want for a tax outcome. So the losses come through to the shareholder now, who's a salaried investor, who's been paying tax on their salaries, can claim the losses from the IRD, and the IRD will give them tax refunds of the losses coming out of the look-through company. So that's the basics of a look-through company. Now there are some rules surrounding deduction limitations in look-through companies, and they essentially limit the amount that you can claim to your economic exposure in the company, which is kind of a fancy way of saying you have to have something at risk, some cash you put in there, or some alternative securities that you put up as security for the deposit on the house. You have to have something at risk in the company to get the loss out. It's pretty hard to contemplate a situation where the deduction limitation rules kick in and bite you. It is theoretically possible, but we find for most investors, those deduction limitation rules or loss limitation rules or membership basis calculation rules as they're known, it's very rare for them to cause you a situation where you can't get your loss out. So don't worry too much about those, but do take advice from your advisor as you're setting one of these structures up in that area, because for some people it can be a concern. But for 99.99% of the population it won't be, which makes this the perfect structure, and I'm going to show you a couple of reasons why. But before we dig into that, let's now take this structure, the look-through company, where you take the losses out, claim them off the IRD to get tax refunds, and apply that to a husband and wife scenario where one spouse is working and the other spouse is not working. So in this case, husband's working, the wife's at home looking after a young family, so she has no income, but she's working very hard looking after the family at home. So in this situation, or this example, we put 100% of the shares into the working spouse's name. And that's because we want the property, in this case producing $15,000 of tax losses. That's come from the rents minus the expenses. We put these tax losses through the company out to the working spouse because we need to make sure that the losses end up in the tax return of the spouse that's actually got income to get tax refunds. So there's no point in splitting the shares 50-50 with the spouse that doesn't have income because they can't get tax refunds. So point number one, the shares go to the spouse that has income so we can actually get the tax refunds. So in this case, the losses, rent minus expenses, flow through the company up to the working spouse. So we're getting tax refunds from that. Now, notice that the non-earning spouse, the spouse at home with no income, we've actually removed them from the shareholding, and that's for a couple of reasons. Firstly, if you keep your spouse that's not earning out of the shareholding, you can make an argument with the banks that your spouse should not need to sign the personal guarantees with the bank. You should try and do that if you can. It reduces risk to your family. A second reason on the tax side of things is that it's possible to declare a spouse salary to your spouse at home if they're managing the investment portfolio. So consider this, let's say that there's a couple of properties in this portfolio and the spouse at home's doing the property management and the books of the company. You could pay them, say, if it was market value, say $10,000 a year to manage the properties and the books of the company. Their effective tax rate on the first $10,000 might be, say, 15%, near enough. So that's $1,500 in tax that's due. That $10,000 now flows out to the income earning spouse. Let's say their effective marginal tax rate is 33%. So you get to claim $3,300 but pay $1,500. There's an $1,800 advantage to you there. So that spouse salary can only be paid from a look-through company where your spouse is not a member of the company. Otherwise, the salary is non-tax deductible to a look-through company. And that is a quirk and a change of rules that didn't used to be the case with LAQCs. So with LAQCs, loss attributed qualifying companies, the old structure that we used to use for clients, that structure, you would typically split the shares 99-1, do a shareholder salary at year end to declare a spouse salary if that was the situation you were running. And it was very easy at year end. IRD didn't like that, they changed the rules. It was too easy to do this. So now you can't do shareholder salaries because if your spouse is a shareholder, the salary becomes non-deductible. So instead, if you've removed them from the shareholding, you can declare a salary on PAYE, which is a bit of a pain in the neck because you have to do PAYE returns. Effectively, the company's an employer that files employer returns. But if you do that, and your spouse is not a shareholder, and it's a market value salary for work actually done, then that should be fine. And you end up with an advantage potentially between the low marginal rate of the non-earning spouse and the working spouse who's on the higher marginal tax rate. So that's something that you could do through a look-through company that you can't through a general partnership. You'd have to ask IRD's permission through a general partnership or a sole tradership. Okay, those rules for partnerships and sole traderships are different. So you don't have to ask IRD's permission to do this. It's lawful, and that gives you some tax advantage. The extension of this is, of course, asset protection. We now want to keep the lawyer happy, so we bring a trust into play, and you put your family home into the trust. That's where you have all your equity. It's protected behind this wall, this vertical red dotted line that denotes a protection wall. So you put your home into the family trust and your investment portfolio in a look-through company with the losses flowing through to you. So let's just pause for a moment and say, what happens if there's a financial disaster now? Well, one of you is sheltered from the banks if you've done that part right. So one of you's in the gun with the banks, and if you've separated the banker on your investment portfolio from the banker on your home, so they're different banks, then it's quite possible that if the disaster comes from the investment side, that your family home is protected. So that layer of additional thinking with how you structure your finance also needs to be brought across the top of this. Typically, a good broker will know how to deal with that, and we've certainly got great brokers that we work with here at Gilligan Road who we can introduce you with if you need that. Last comment, some people could very well be concerned that if they are the non-earning homemaker spouse and the shares of the company are not in their name, that they could be taken advantage of if there was a divorce or separation. And what's key to understand there is just because the assets are in your partner's name doesn't mean that they are separate from the relationship. And typically, if you did have a divorce situation and you had the shares in one of your names to take advantage of the structure and you ended up in a divorce situation, you would simply caveat the titles of the property as the other spouse and stop the